Hello, today is the 23rd of June, 2011. It is 10:30 New York time in the morning, and silver is currently at $35.26. This is the SLV chart up to yesterday, and it lasts now about a year, 15-minute line chart. And now all these slew of moving averages are trading within them. It includes a bunch of different volume weighted average prices and the 5, the 10, the 20, the 50, the 100-day moving average, all moving in there. The 200-day is not shown on there, but it's not going to take long now before that starts to join the party within all of the other moving averages. I've said this before and I'll say it again. This is a trend line that I need to see parabolic moves. It's been hit on a few occasions. It was originally set back in August and September of 2010. And since it had its first correction on this bull market, it had one retest of this level. We have now had a second significant test of a correction, that is, so not a test of the trend line, but a second correction, thus taking us very far away from the trend line. That's the level I need to see for things to go extremely parabolic on silver, or even that of the currency death. The next chart is the quarter day chart, or the movements going back to February of this year. Right now we've got this pattern of lower highs. We got the pattern of lower lows. For the lower low pattern to continue, it needs to break down below this line, and of course a higher high would be nullified by bringing out that particular level. As far as the Fibonacci is concerned, the Fibonacci from this high to this low was met somewhere up around here. Therefore, it's still been not only a successful selling move thus far, but successful with added momentum towards the downside, because it really needs to hold or stay below right in here, approximately wherever the 61.8% would be, maybe even down towards 43. I don't know this number offhand because there hasn't been a need for me to know this. It hasn't broken above the significant resistance. Overall, correcting mainly sideways through time after a corrected through price. So price correction, sideways correction, and thus showing in decision. Now the Fibonacci from this low to this high, it came down exactly at the 61.8% Fibonacci level. It found a little bit of a bounce. It's actually coming back to it now as I'm saying this, but if it does, and the keyword is always if it does find the key level of support there, comes back higher, then it increases the chances of it taking out this significant high. If it doesn't happen, yet it comes to that level and it goes back down, then you would create a double top formation that's bearish. And there's a reason, and the reason why it's bearish is because it didn't break this resistance as it was supposed to. Now, in a situation where it comes back down and then does this, well, then that's normal trading, but it never even made the double top formation because it didn't find this low. That's why when you look at double tops, you got to create both sections. There are so many people when they see a chart go up like this, oh, there's a double top, there's a double top. No, that's not a double top. This would be that of a double top. And again, if, say, for example, the Fibonacci does what it's supposed to, find support, and let's assume that it finds 61.8% from this low to this high, then it's going to find a lower high. You come back down here, and that increases the chances of taking out what support was set today. Thus, it would give us a test down towards here. And then the next test would be the big lows of roughly around 32.75 as the next key support area. Again, everything is down today. The stock, Dow Jones is down about 200, oil's down about $5, gold's down about 30. It's been a little bit of a massacre again today. And if the stock market ends up going down tremendously, what's that going to mean towards gold and silver? You know what, myself, I really don't care too much, because I'm going to go with the same theology that I've been going with for the last many months. And that is, the lower that silver goes, the larger the disconnect will become. And when I say disconnect, I mean that within the physical metal, which would be resulted into much higher premiums, It could also result into just not getting your silver or when you want to because of 3 week, 4 week, and 6 week delays. Those are the things that I would normally expect to see. But within the same point, since this market has been consolidating for the last little while, people just aren't talking about this too much from what I've noticed, losing interest or even believing the fact that silver is random and that it's possible that this might be an all-time high for 10 years or 20 years. And well, that just makes me wonder. Next up is the daily chart. Staying sideways amongst this level. This to me shows it the best how boring this range has been and how neutral if you've been looking to buy on the dips. And let me pluralize that for you. People say buy on the dips. This is a dip, meaning if it goes back lower, we will have dips pluralized. And how much time have you had to buy on this dip? You've had about 2 months now, almost. Since it's about 50 some odd days, that's about, or 30 some odd days, that's about 7 weeks, that's about 2 months of just going sideways within this movement. The volume on SLV shares much lower than when the crash came down to a conclusion, trading really close to the volume that we traded even back at the end of December, start of the year. Lighter volume, but as far as the market's concerned, we stay bullish above this level. This really takes us to neutral, and this takes us to bearish. So that bull market that's been going on for the last, 10 months, 8, 9, 10 months, will come to a conclusion if we have a confirmed breakdown below this level. On this particular chart, long-term charts like the monthly and the weekly even, quarterly, it takes a heck of a lot to destroy that bull market right now. But as far as the daily chart's concerned, when you're only connecting this low and this high, it's got to stay above the 38.2% level for it to be bullish. So it's still above that level. Therefore, in this case, it's still bullish. But oftentimes when you find these significant support levels, if you were to buy them blind, meaning buying them on weakness, then a lot of times that can work out. Now, I stated 39 was a significant level. Obviously, it was significant, but it wasn't significant for support. It was more significant for resistance. But as the market came down here, okay, let's now buy on weakness because it's at Fibonacci. And well, you had a bounce and maybe you profit took in here. Well, now you're getting the point. Well, now this whole great level that this 33 level was back in May isn't so amazing today here in the month of June because the market found support and has moved sideways ever since. And a fast move below this line could very easily give us a fast move towards this line. It's possible. I'm not going to say it's likely, nor will I say it's unlikely, but rather I would say it to be possible. We also have this 200-day moving average, which could very easily just continue correcting within the sideways action, meaning the market continues to go straight, the 200-day moving average will catch up with it. The 200-day moving average is a spot you would expect to find support the first time that it touches the level. And we haven't touched it yet since we broke away from it back in August. It still has a little ways to go because with the market currently at 35 and the average at around 31 and change, it's got to go down over 10% as of now to even have a test of this 200-day moving average. You could say the same thing about the 50 here though too. You come down the 50 for the first time since the breakout, it went below it, showed a failed move, and then went above it. Second time I went to the 50, it didn't hold, and it's been resistance ever since. So this would end up being the first test of the 200 when it happens. Take care.